Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Tuesday, August 3rd, 2021. There's not a whole lot popping today. I've been, in my office at my desk, just watching, looking, and really don't see a lot that stands out. But I did want to do an update. A couple things that I haven't highlighted in a while. We're going to get to Bitcoin and Ethereum, so we'll look at the cryptos real quick. Some things worth there pointing out. As usual, I'm going to start out with the equity markets. I'll keep it relatively brief, show you the levels I'm watching. And I also, after the equity markets here, I'd like to show you a few sentiment indicators. I was catching up on some of the previous comments that I missed the last week or so. Somebody asked about the put to call ratios, so I definitely want to talk on those. And anything else that might stand out, maybe the DM trade idea, wheat, corn. We'll keep it relatively brief as we have recently. Most of the videos been about 20 minutes or so recently, and this one shouldn't go much longer. All right, we're going to start out with this chart. This is ES, the S&P 500 E-mini futures, and we're looking at a 60-minute time frame. ES right here. And the story on that is we've just continued to work our way up. We had a small divergent high here, meaning negative divergence, and we had a small correction. Then from there, we bounced, we went up, we extended the same divergences from this point right here. They grew larger in a larger correction. Now, I often say that typically, not always, but typically, the bigger the divergence, the bigger the ensuing trend change once it sets in, whether it's bullish or bearish divergence. This is negative or bearish divergence. So we had a correction 1, pushed on, extended the divergences, correction 2, and all we've done since then is extended those same divergences from that same point to this point right here. And so far, we haven't had a correction. We've gone sideways. And the level, since the last update on ES, I've added 2 levels to the chart. I added this one here, 43.65 and a quarter, we'll call it right there. I see enough reactions, especially this one. Almost right there, very close. Another tag of it right there, a little reaction around there, reaction high, and so forth. So to me, this is probably in near term the most significant level on the S&P 500. And again, that's 43.65 and change. We'll call it 43.65. Might as well to be safe. Now, so what's happened in recent days here, we've been chopping back and forth in this little sideways range, and that is like a coiled spring, building some energy when you get in these consolidation range. And we can certainly break up. How far do we go if we break up? Hard to say, but I can tell you from these divergences that I would expect any new high will be only a marginal or a slight higher high. And if we do, you can see I'll just extend that divergence line and we're still going to have the negative divergence. Now, we could continue to go up and burn through the divergence. That sometimes happens, but more often than not, the divergences will play out. And again, we can certainly break to the downside of the range. So all I can tell you is until and unless we do, this is a level to watch. We're in a trading range sideways. Again, a upside breakout because of the divergences just wouldn't be an upside break that I would chase. That's just my style. Let it go for me. Now, you can go long if that's your thing, but I always say that breakouts that occur with negative divergences, upside breakouts, tend to fail in reverse. And so I'd rather just sit and wait for a break of that 43.65 to add to or initiate any short positions. And I added one other potential target here today, about 43.09 right there. We have some reactions. So I think if 43.65 breaks, that is minor support here, about 43.45, but I would expect probably move down here. Whether we get a reaction there or not, it would probably be very minor, if anything, and that would be a minimum near-term target. And then you can see the additional targets: 42.79.60, 42.23 and change right there. Next up, this is a 60-minute chart of NQ, the Nasdaq 100 futures. This was our primary trend line on the 60-minute time frame. We put in a divergent high right here, DH we'll say. We broke down backtest, had a little correction, backtested again, extended the divergence, made it even larger. And again, same story. Should we happen to pop this little, you can see a little triangle pattern forming here, an upside break, and any marginal new high, meaning a slight high followed by a reversal, would only extend the existing divergences. And so therefore, that's, I think the upside appears limited. And of course, if you get a downside break, that would be bearish. But the big level to me is still 14,788. I've been highlighting that for the last few weeks, and that is a support level I think that needs to get taken out to open the door for a deeper correction. There's some minor supports, but I think first target would be about 14,479, and then 14,313, 14,066, and so forth and so on. But again, the pattern lately has just been kind of grind around, go nowhere, and so there have been better fish to fry lately, and so we'll get to some of those. Before we do, let me talk about the sentiment indicators. I'm going to start out here with this one. This is the CPCE. There's various put to call ratios. That is a measure of how many puts are being bought versus calls, or are out there, the total issued open interest. And you have the CPCE as the equity only, so that measures put to call buying on the individual stocks instead of the indexes, or a combination of both. And so what I've noticed, I've had this chart for many years. It goes back to late 2003 right here, and I put a line. And that line is at the 60 level, just above about 61, 62, and that's a 100 period moving average. So a simple moving average, 100-day moving average. That's a daily chart. And what I've noticed is because the put to call ratio, it kind of looks like an EKG. It spikes up, and you do want to look at those extremes. That's usually a good time to be either buying when you're down at the extreme low. Those are good buy points, or selling when it's high. But in this particular chart, again, what I'm focusing on is the 100-day moving average falling down to this level here. And you can see that that's going back all the way to 2003. It happened right here. We stayed that low right there, and that marked the top of the Great Recession right there. The market peaked in October of 07, fell almost 60% down into the March 2009 lows, so that was a heads up. And again, by using the 100-day moving average, it kind of smooths out. It shows extended periods of persistent bullishness when you drop down to low levels here. That's what you're showing here. When there's a lot less put buying, more call buying, it brings the put to call ratio low. And then it spiked, as it usually does in a bear market. People start buying puts. Sentiment gets bearish and bearish, more bearish, and then things peak out. And it hit it here in early, that was early 2011, just before the market had a almost 23% drop. Fell right here at this point, hit it, and the market, that was followed by not only about a 16% drop. By the way, it was 20% or more, or close to 20 in the NASDAQ, over 20% in small caps, mid caps, and other indexes. So by that technical definition, those indexes hit a bear market back here. And it was also, even though it was only on the S&P about a 16% drop, the market went sideways for over a year and a half, nearly 2 years. So again, this is just telling you that sentiment is excessive and the risk reward isn't favorable, and it increases the odds that a correction will come. Well, you can see what's happened since then. Now, a lot of things are different this time. I've had indicators, and I've been harping on these put to call ratios for a while, because for many years they work just about as good as any buy and sell indicator that I have. And I always say they are not exact timing indicators. You don't go long or short, or get out of all your 401k or into your 401k long when it hits those levels, because it's more of conditions in the market, excessive bullishness or excessive bearishness. And those conditions can and often do persist for quite some time. Sometimes it's relatively short. You get it, and then the correction or the bottom in the market follows. And sometimes it can come months or even years ahead. But what it does tell us is that the bullishness is at all time, at least by this metric, multi-decade highs. And again, low put to call ratio means excessive bullishness. And this is a function of what happened when COVID hit. The Fed has distorted the financial markets undoubtedly. Nobody's going to argue that. They came in with the nuclear option, unprecedented steps to buoy the stock market and support the economy, and so it's kind of thrown things off a little. If the takeaway from this will be that because of these excesses, when they are corrected, we're probably looking at an oversized reversal or a correction or bear market in the market if and when it comes. But again, not a timing indicator, just kind of showing you right now there is a lot of lopsidedness in the market. Too much bullishness, not enough bearishness to sustain, especially almost not parabolic, but a near vertical advance. Those usually don't end with corrections that are small. They usually, when you go up really sharp, you tend to come down. I'm trying to draw an arrow tool pretty sharp as well. All right, again, that's one of many. I'm not going to cover each and every one. We'll look at one or two more. Here's that same put to call equity put to call ratio index right here, and this one's going back to 2007 on the left of the chart. And this one's pretty simple. I have this a green line, or at least a line I put there at about 113 or so, and colored it green. Spikes up to that level represent extreme bearishness or fear in the market. A lot more put buying than call buying going on, and the signals are usually far and few between. When you get there, and this is the opposite end right here, extreme bullishness, complacency, and again, you don't have many readings. We're spanning back, going back all the way to 2007, and so this told you everybody was bullish right there, or not extreme bullishness, and you had, again, some of the biggest corrections that we've had in the market when you reach those extremes. Now in a bear market, you're going to see these spikes in a true bear market, and they actually came at the counter trend rallies, and each time it was time to get there was more downside to come, but we did get the those spikes there. And again, what we're looking at now is these green tags. That's when you want to go long. That's when everyone's freaking out after these corrections. And yeah, again, they were, I should say, these spikes here came at these bottoms, and there were bear market rallies that followed those spikes. Last time we hit the buy signal was right here, or no, this was the last time in that drop into the March low. So pretty darn accurate. Again, if you look at, freeze the screen, look at the charts, draw lines down, see where your buy points and sell points would have been. And I often talk about this. A lot of times it's one and done, the spikes down to these extreme levels, but this has been an unprecedented cluster. So again, you can say what you want about it. I don't view this as a false signal, a whipsaw signal, the fact that we hit it, because I view this is persistent bearishness. I'm sorry, bullishness. And so it's, if we hit it right here, the first time we hit it on this arrow, and the market kept doing this, and this did this, then I would say, okay, it was a false reading. And there are some whipsaws. But what this is, again, it's instead of a single tap, we've now been for nearly a year with this persistent bullishness, and again, it's due to the distortions in the market. But I believe there'll be a price to pay for that when all's said and done. Once the ship finally turns, once the trend changes, that's indicative of a more than just a little minor pullback. When it comes, well, that's why we keep looking at the 60-minute charts and the daily charts. So we're not there yet. I gave you in the beginning of the video levels to watch. And last but not least, then we'll move on, hit a few more things and wrap the video up. Okay, this one is the AAII bull to bear ratio, and again, it's that's the American Association of Individual Investors, I believe, and it shows again, I just put a line here where it seems to be the magic number, and that everything shifted a little bit. You can see this red area here shaded. It's supposed to be above that line. Sometimes these charts will shift. These circles are supposed to be down a little lower. Bottom line, you hit that level, that means you have excessive bullishness, and which from a contrary indicator is bearish, because when everybody's bullish, again, not literally speaking, metaphorically, or the masses, everyone has already gone long. They're all in. The last bull has bought his or her last share of stock, and there's no one left to buy. And you also have very low short interest. Shorts have been blown out of the water, and you don't have those shorts to cover on the corrections or the dips, which usually, in a bull market will keep it and lead to the next leg up. So you can see when you got there, you wanted to sell. When you hit here, you wanted to sell. We had a few buy signals, and they were just bear market rallies because this was the great recession, the big bear market back then. We didn't have that signal again till right here. There was our sell signal. There was one of the biggest drops, big correction in the market back again 2011. We hit it here. There was a correction, double digits. We hit again. I have them all highlighted and shows the red correction, little spikes a lot in this area. A cluster of readings followed by that sideways or bear or near bear market back in 2015 to 2016. We didn't touch it again till right here. So that was 2018. And boom, look at that big drop right there. Again, one of the biggest in years. We never even got it before COVID on this one. That was that big COVID drop. But we have hit it here, and these are persistent. These are clusters that are coming in close proximity. And again, it's just showing you the state of the market. We're hitting that extreme bullishness where more often than not, the biggest corrections that we've seen in years or even decades have come from levels where you have extreme bullishness. Likewise, you want to be buying at the green zone when everyone's bearish. You want to buy right here. There's the bottom. Buy there. There was the bottom of that correction. Buy right there. It was a good buy. Right there, that extreme spike, that was the end of the bear market back in 2009, early 2009. So that's that. And again, just conditions of the market. We'll need some decent sell signals, and that's why I'll continue to monitor, day in, day out what the indexes are doing on a shorter term time frame. Okay, and there's an update on Bitcoin. So on Bitcoin, for those of you who recall, way back when, it was back here, gave a sell signal. I was waiting for a break of the trend line, posting. Sell signal came right there the very day after Bitcoin hit its all-time high. And then I laid out 3 targets, T1 zone that was hit there. We bounced on it for a while, danced on that first target zone, then we broke it. At the time, posted, said that's the next sell signal, solid break, should take us to T2, which it did. Hit T2, bounced on T2 for a while, and then we hit T3, which was my final target right there to the button. And even that same day, this was on June 22nd, earlier, we were getting close. I give a heads up. Close, expect a reaction. We got there, boom, hit T3, and then I posted GBTC as an objective long entry. Cover, close out any shorts if you're still in it, and it's an objective long. Again, that was June 22nd. So now we're going to fast forward to today. After that, I had added, there was that tag right there to the button. We came back tested it again. I believe that was also posted as another objective long entry. Laid out 2 price targets. T1 actually was back here first, so that target was hit there. Then T2, which was my final target, was hit right here. Recently, at this point, let me tell you when exactly that was. July 26. We made a slight overshoot of it, but look, we're rolling down off it. So that is effectively a rejection. It's a momentum-fueled overshoot, and we've fallen back below it. And I told you before, I suspect, although I was looking for a bounce here, I suspect there's a good chance we're going to go even lower. And this was back then and still is kind of an unofficial target, but a potential target. And I think there's a good chance we may see it, and that's $17 on GBTC. Either way, I don't have strong convictions, and I think I told you in the last update of it, I'm not in Bitcoin or Ethereum now, but I suspect that may be the end of the run. If I had strong convictions, I'd be short. But I could also see the potential that it's just consolidating, pull back, and it may run up here. I want to just give you the levels. If we do get another thrust up, if you are bullish, 39.25 would be my next target. It's very good resistance, and so there's a decent chance I can get there. But then again, this area was and still is pretty good resistance, about 33, 34, 35, and there's a big old gap right here to be backfilled. So there's the top of the gap right there and the bottom of the gap here. So if we get we roll over, we'll probably come back down to my former first target on the way up. That's 28.15. So there, I just kind of want to show you what's going on in Bitcoin, and I always try to convey my thoughts, whether I have strong convictions, not strong convictions, and I do these updates because I know there's always somebody following and trading Bitcoin, and so whether I'm trading or not, I'm glad to share my thoughts on it. ETCG, similar. I laid these levels out here, and we hit that one right there, 41.13 after the breakout of the downtrend line. Oh, and that was also mentioned as objective long because I had this target here, 22.44. So the very day, I think, what did I say, June? Yeah, June 22nd. That same time, Bitcoin hit the final target T3. Ethereum hit that 2244 target, and that's why I had even very high convictions on a bounce because not one but both of the two prime, biggest cryptos out there at the very same time hit very good support, and so that's therefore you got the bounce. I mean, the bounce was, this is log scaling, so don't underestimate what it doesn't look like much, but it was a 84% bounce in a matter of just a couple weeks, and came back tested it again, and we're kind of floundering around. And again, because of that, we're kind of in no man's land between support and resistance. I don't have very strong convictions, but if I had to bet, if you put a gun to my head and said, Randy, you got to go long or short, what's it going to be? I'd go short, and I'd be targeting this trend line here, which has still not been hit, and that was just below that 2244 target. So that would be my price target. If it goes up before it gets there, or maybe it never gets there, but if it does go up and you're bullish on it, 48, that would be the target. We already hit the 41.13 target, and so if that gets or resistance, and if that gets taken out, $48 is the next resistance. It's not as solid as this one. This is better, and again, this is my preferred scenario right there. That'd be an alternative scenario like that. All right, nothing much to update on gold today. It's mostly flat, hair down. I'm still bullish on gold, near term and longer term. Wheat is offering. I wanted to update this because I mentioned it yesterday as an objective long and a breakout. I also said I'm favoring corn. I think there's a little more upside in corn. It tends to run with wheat. There was our breakout yesterday, and we had a perfect back test. So if you missed the breakout or didn't take it, and we're not far from it now. The support's about 717, 674, and we're at 724 and change right now. So we're not far above it. So again, you can go long there. Anything much below that, a little slight dip below, followed by a reversal is okay. But anything much below that is going to take out support. It means that we had a false or failed breakout. You could also put a downtrend or an uptrend line, right here. So this is, somewhere in here is an objective stop if you're buying it going long here. Because if it breaks down, then again, it's going to be a failed breakout, and it could take us back down to any or all these former targets are now support levels. So that's wheat, and then like I said, corn's going to tend to run with it. The chart on corn isn't as clear to me right now, the levels, and just based on that chart alone, I couldn't make a screaming case. But as I said, it will tend to follow corn. Corn will tend to follow wheat. And let me grab the chart for you. Here it is, ZC, and usually get more bang for your buck, especially if corn needs to play a game of catch up. So there it is, corn hit, and it's been bouncing off this level, 558 and change right there. Needs to break that out. Next target would be, it's more of a zone, but I'm going to say this top level here, 572, 313, then 582.20 we'll call it, then 595.46. Those are still the targets on corn. ZC corn futures, and you can trade corn, and CORN is the ETN, and WEAT is the ETN for wheat. Crude oil, one of my favorites as far as commodities on the short side right now. There was our sell signal, divergent high, and we've been stair-stepping lower, a little wedge set up, breakdown, give you another objective. So short entry 1, objective, short entry 2, drop down, hit this 65. I think the target, I might have had it there. I can't remember where it was. I know I had that $66. So 65 to 66 is a support zone, and rallied up, and then again, another little wedge type pattern right there. That's not how you draw it, right there. And boom, another breakdown, took out 72.63, hit it yesterday. I mentioned that there. Bounce, we got our bounce off that 70.42 support, and now we've taken it out. We're a hair above it, but I expect the fact we already hit it once, I think that's it. So I'll say it right now. I think this is an objective shorting up on on crude with a stop not too far above. You could have a loose stop above 72.63 or a relatively tight stop, because I think this is just a slight overshoot and we're going to go down and at least hit these targets again and quite possibly more. And I'll tell you, if there's more and more fears of this Delta variant coming out, as you guys, I'm sure you know, you're watching the news, more and more states or municipalities are requiring or either suggesting or outright requiring masks, and it's people starting to worry about it again. So you get even, you don't have to have a full shutdown of the economy. A full shutdown of the economy would just collapse oil. We all know that. We saw what happened last year. But even just a reduction, think about it. Are you expecting to see planes, the airlines get more and more bookings now with the Delta variant flaring up? People worried about that, or more cancellations? Think about cruise lines. Somebody mentioned a couple weeks ago, and I did look at it, and I'm going to probably cover it in another video, the airlines and some of those stocks that were supposed to be beneficiaries of the economy coming back online, because they got really overhyped, overheated, and airlines have already been moving lower. So I'll cover those in another video. But you get, if things get worse on that front, then I can tell you this: you'll probably have more bang for your buck shorting crude oil than you will shorting an airline. I'm talking percentage term drop. And so crude is still, one of my favorites right now. As far as bullish things, I think lumber, but there's, like I said, it's a kind of a double-edged sword, because if and when the, if the Delta variant starts flaring up, and then the economy softens, you're going to see housing prices soften, and then that's not going to play out. So here's what it looks like on it's actually a 30-minute chart. We hit this new T1. This is still T2, T3. There was the last breakout right there. I added a little line here. There's a line at the recent lows on lumber futures we've been dancing on. So a lot like the stock market and many things, we're kind of grinding around sideways recently. Overall, I am still bullish, and I think the downside's minimal. Remember, lumber futures have dropped about 70% in around 3 months or so since they peaked. Now, they got way ahead of themselves, and so the big drop was coming, and this one was pretty extreme, but then again, it was commensurate with the move leading up, the big run up that we had. And so bottom line is, I think the downside is minimal on lumber, and the upside potential is good. Now, if the market holds up, then I think there's a very good chance we're going to go on and hit this, at least that third target in lumber. Okay, 2 other trade ideas. I just wanted to do an update on DM. The chart's still constructive, and we still have a little time. August 16th after the market close, if that is accurate. Sometimes when I get the information off earnings.com, one of those sites, the one I have a link to on the site, and they'll when it's pretty far out, they try to predict based on their last earnings. Sometimes those dates may change. I haven't verified that, but give or take, this one should be reporting here in a couple weeks. And so there's time to see a run up, but the closer you get to earnings, unfortunately, the more likely a stock is to go into a holding pattern. Who wants to take a big position? Unless a little birdie starts leaking a lot of news about positive or negative earnings results. So this one, it hasn't panned out yet. I was hoping that it would have panned out earlier. In fact, we're underwater a little bit on this, but it's still constructive. That's what I want to point out. And I would put, based on the charts, I would put good odds that any reaction after earnings, after they report in a couple weeks, will be positive. So what I'm watching now is this downtrend line, but a little triangle there. We popped to the downside, but what that did is it's simply not only kept the divergences in place that we already had, but it's made them even larger. So there's still potential for this one, T1, T2, T3, T4, and a potential T5. Should the stock market hold up, that's certainly going to help. Right now, I'm keeping this as a final target. And again, just want to do an update, so it's kind of a go nowhere trade so far. Maybe a little bit underwater. When I say a little bit, if it's percentage, it's a high beta stock. You don't put that much into a stock like this. You use a smaller position size when you're shooting for a, from, I don't forget where it was mentioned here somewhere. If you're shooting for even T4 which is a gain of about 30%, you can give yourself a 10% stop loss. And again, I forget exactly where it was posted, but if it was where I'm holding the crosshairs here, we're only down about 5%. So that's still, pretty attractive risk-reward ratio. And last but not least, time for an update on AMC. AMC has been, moving lower. The sell signal came on the break of this triangle right here. All right, so the triangle, we broke to the downside, stair step lower, hit the first target, moved down. T2 was this intersecting uptrend line, so that really formed this larger triangle pattern. And also said, because they came in close proximity, 33.13 or so, and so that was hit, and 33.13 was hit, we bounced, and then the trend line was hit, and we bounced. Now we're back to it. We already hit it once, so therefore I favor a downside break, but I'm going to be very clear. If and when we have a solid break below, we'll just say 33 for safety. And the farther we get away from that is going to sharply increase the odds we're going to go down and hit this next target here, about 14.58. So there's a big old thin zone. That's right here where you don't see these red and green bars, meaning very few people bought right here. The volume, most people that bought AMC, you can see from these green and red volume at price histogram bars. That's telling us the vast majority of people bought up here. And so when you break down, you're going to get a combination of stops being hit, margin calls, because I know this from reading up on this and knowing people that are into this kind of Reddit thing and chasing these. They've got all their money in there. They're margined out. Some of these people, they believe, and it has not panned out yet. So it's just, that's the psychology of trading right there. And, and the mechanical part of it too. Both stop loss orders being hit and forced margin selling. If you have you put 50 grand in AMC and you leveraged up, you had all your money in it and you were buying on leverage, and the stock starts dropping, your broker is going to issue a margin call, and if you don't sell it, they'll do it for you. So that's what I'm looking for. We need to see that level go, and if it goes, the farther we get away from there, the more you're likely to see that waterfall selling down to that level. Probably even overshoot it, because we'll be heading in so fast to get there. But again, it would be first target. And then if we overshoot it and you want to hold out, we'll probably come down here at about the $12 level. That's the 60-minute chart. Daily chart looks like this. There's closing bell. You have this uptrend line right there. It's a little different than the 60-minute chart I have, and we're below. I had 36 as support on this daily chart, but remember 33 is my support level on the 60-minute chart. And then these are the targets: T2 zone, $20 down to about $17.50, T3 $14.55, T4 $11.94, we're going to call that $12, and then T5 $9. So that is my maximum and what I believe to be a potential downside target for AMC, which would be quite ugly for those in it and quite profitable for those shorting if it happens. So a little more downside, look for that, and maybe add to or take a position if you don't already have one in AMC. All right, we're going to wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.